Welcome to the Live Well podcast, where we explore how to navigate life's biggest changes, overcome challenges, and build a future that aligns with your goals. Hi, I'm Matt Wilson, financial advisor, coach, and business owner of my practice here at Cornerstone Wealth Services in South Bend, Indiana. And I am so glad that you're here. And I want to give a special thank you to TruthWorks Media for hosting the Live Well podcast here in the Momentum studio here in South Bend, Indiana. It's a fantastic facility, and they do a great job, again, of helping people bring meaningful conversations and stories to life. We're in episode 3 of a 4-part series here, the 4 pillars of successful investing, principles, not predictions. So we've covered buy quality, be balanced, and today we're going to talk about the 3rd pillar. Remember, there's 4, otherwise your table collapses. Structure is going to collapse. It doesn't matter how good your portfolio looks. It doesn't matter how good your intentions are. If you do not have these 4 pillars, then I can tell you it probably will not end well for you. In fact, I know it won't end well. The 3rd pillar that we're going to talk about today is diversification. And I'll say this up front. Diversification is one of the most misunderstood concepts of investing. So let's just talk a minute about what diversification really is by talking about what it's not. What it's not is having multiple advisors. What it's not is having money in multiple banks. It's not spreading accounts all over the place and having a plethora, if you will, of accounts and advisors. And, you may have multiple CDs, and that's fine. You may ladder things out like that, but that's not diversification. That's location. True diversification is owning. Number 1, different types of assets. Number 2, different sectors. Number 3, different sizes of companies. Number 4, different types of bonds. Number 5, different strategies potentially. So you may not just have all your money in bonds or municipals, and that may be appropriate if you have a large amount and you can ladder things out. You can stack different length or term bonds into your portfolio, if you will, but you've got so many different variables here. There's so much to investing. I've got a Series 7, and it's important to remember that a lot of these personalities that are out there, whether they are people that are respected or people that are controversial, they throw things out there, and a lot of times, they may say something and it's not entirely accurate or maybe not the most helpful when it comes to what's available to you. And it's important to remember they do not have a Series 7. And I was told when I got the Series 7, which is basically like sitting for the bar exam. You sit all day in this room and you've studied for months, and a very high failure rate in passing this exam. And I was told, take everything you've learned, and yes, you know more than 95% of the American population when it comes to investing when you have a Series 7, which is a staggering statistic. But I was told, hey, take all that, write it down, now throw it in the trash can, because the average person doesn't necessarily need to know or want to know all that stuff. They just want to know, am I okay? Am I going to be able to retire when I want to with the income I'm used to? Are they going to be able to live the life that they dreamed of when they set out to retire? Maybe they don't even know what that looks like, and a lot of times people don't. People don't know what they need. They don't know what they want. They don't necessarily know what their dreams are because nobody's ever asked them. They've never really had time to sit down and talk about it. So here's the thing. I want to talk about all these different elements, whether it's the 11 sectors in the stock market, whether it's, all of these different companies that you can buy and you can have ownership in, the international exposure. And oh, by the way, there's over a dozen types of fixed income too. So the real question becomes, are you actually diversified or are you just spread out? Let's just stop for a minute and hone in on why diversification works and why it matters. Here's a statistic here that might surprise you. Over time, stocks have averaged 11.2% returns, bonds about 5.5%, but a 60-40 portfolio still returned about 9.3%. with significantly less volatility than the stock market. So I'm going to put these slides here in the show that we have on YouTube here, and I'll also put these in the show notes as well. But I want you to take a look at this because here's what's even more powerful. Over 20 years, stocks grew from 100,000 to about 838,000. That's crazy. A portfolio that is more balanced, it grew to 590,000. It's not as high, but the big difference is that it was much, much smoother. So, and it's much easier to stay invested when it's smoother, and more people are going to be able to withstand the ups and the downs of the market if they're not experiencing those high waves. You know, if you've ever been out on Lake Michigan or the ocean and you get those big rolling waves, boy, you can get sick pretty quick. So how can we keep that a little bit more level? So it's not about the highest return. What it's really about is about the return that you can actually stick with. Is what you are currently invested in, is what you currently have, something that you can handle when times get really tough, when the seas start to roll a little bit higher than they normally do. So another important principle here, I believe, is that time reduces risk. Let's look at the statistic here. If you look at the rolling returns, a 1-year return can swing wildly. I mean, you could be up 20, you could be down 20, you could be up 30, you could be down 30. A 5-year return spread narrows quite a bit, and then the 10-year narrows even more. And a 20-year return, if you look at the average rolling returns in the 20-year span, becomes incredibly consistent. So it kind of proves what I was talking about earlier in the first couple of episodes, where investing is the opposite of gambling. And in that gambling, the more you invest, the longer you invest, the greater your chances are of what? Making money or losing money? Well, typically, and I can tell you this, that a lot of the casinos that are out there are not built with loans. They're built on the backs of the people that go in there because the chances go down over time. The house wins, that's the rule. But in investing, it's the exact opposite. If you look at the 20-year rolling returns, the longer you invest, the greater your chances are of making money. So your spread actually narrows considerably when you have that more diversified portfolio. But time reduces risk. So the takeaway is the longer you stay invested, the lower your chance of losing money, but only if you're diversified. Let's talk about behavior as the real risk for a second here. Here's what I really see that gets investors into trouble. When markets are good, people tend to take a little bit more risk. And when markets are pretty bad, people tend to take less risk in those times. So in my practice, I kind of have to keep this in mind because people answer questions on risk tolerance questionnaires, and that's all fine and good. There are different kinds of questionnaires that are out there. There's the kind that's more scientific in the sense of, hey, they're going to see how you feel about money, what you'd like it to do. And then there's going to be some more that are kind of anecdotal in the sense that they're going to put scenarios out there for you, and you're going to answer those. The problem I see with that in the industry is that people change and the markets change. So they tend to answer them with, kind of their feelings about how things are currently going. And so when things are good, hey, we can take that extra risk. Let's get a little riskier. So that's why it's important to have a great advisor and to have somebody who can look at things objectively with you and say, what are your needs? What are your wants? What do you have coming up? What are you worried about? I'll never forget, I had a client who had done really well in the markets. And, we had worked together for several years. He had strong gains, very strong gains. And I recommended that we rebalance his portfolio, take some of the chips off the table, add to some bonds. Let's add some more municipals in the portfolio. Let's protect what we had earned. He said no. He wanted to ride it. Hey, Matt, it's okay. Let's be a little riskier for a few more years. I said, look, on principle, you've made 20, 30, 40%. I think we should rebalance this now. And it was the very peak of the market that year. The day that the market peaked, he said no. And then 2 months later, 2 very short months later, the market dropped 20%. And now he's upset. And not because of the market, but because we hadn't protected the gains that we had the chance to. And unfortunately, I had to remind him that I actually went to him, and I documented the conversation. And I said, look, I asked you to rebalance here, and you said no. I don't know what else I'm supposed to do, but I guess the principle here is that if you don't rebalance, the market's going to do it for you. So let's talk for a second about what rebalancing really does. So rebalancing forces you to be disciplined. And just like I talk about a purpose statement, and we talk about what your purpose is in life, what you're really aiming to do, what your goals are, what your dreams are, what you really like to see happen. we design a purpose statement for all of our clients so that it, number one, provides accountability for each of us to stay aligned with our goals. In other words, we need to be disciplined in our investing approach and disciplined with our portfolio. And sometimes that's going to involve selling what's done well, and that's going to involve buying maybe what hasn't done as well. So it's a little counterintuitive, but I tell you what, if you follow the crowd, people sell when they should buy, they buy when they should sell. And unfortunately, people generally just don't do as well as they could. And it's just because of the behavior. It's because they just don't stay disciplined. They let the markets kind of dictate exactly what they do. And the discipline is actually going to be what enables you to have the success. And it's just like anything. My friend, and I don't like giving free commercials, but my friend Justin Most, fantastic guy, and I'm going to borrow this and forgive me for it, but his tagline, he says all the time, success loves discipline. And I can't agree with that more. In investing, success loves discipline. And it's sometimes taking a step back from what's going on in the media and making sure that you are still aligned with your goals, that you still have the same picture in mind for what you really want to have happen. And over time, it's going to help you to keep more of what you earn. It's going to help you to avoid large losses and stay invested. So let's talk exceptions, and let's be real, because there are exceptions to the rule, generally speaking. In 2022, we had a really difficult bond market. Here's another stat that's probably going to surprise you. And I had a client who said to me, man, I should just be all in treasury bonds. What's wrong with that? Well, in 2022, treasury bonds were down more than 13% that year. It was one of the worst years in bond history. His portfolio was down 6%. So would he have been able to handle a portfolio that was down 13, 14, and maybe 20%? When he had a diversified portfolio, he was only down 6%, and he was saying, well, I should have been in treasury. He didn't understand that stuff fluctuates too. So owning different things throughout the different periods is going to be helpful. So yes, sometimes everything struggles, but that doesn't mean diversification's failed. It just means that we're experiencing maybe a rare environment, and those are the exceptions, not the rule. And so it's important, like I said in the previous episode, make sure you have enough cash, make sure you understand what you need for the immediate concerns and the immediate goals. And then you can handle some of those exceptions that might come along. And again, they're exceptions, they're rare, but they can happen. Anything can happen. Unless you have some guaranteed money, which we'll talk about, I would tell you that you're going to see things happen on a day-to-day basis. You wake up one day and all of a sudden the world's changed. So can you handle that? Can you handle the ups and the downs that come with that? Maybe you want to keep some money aside for that, but anyway, it's a good question to ask yourself to say, look, if everything went down 20% overnight, how would I feel? Would I be okay? Or would that really disrupt my lifestyle? And that's a good question for you to answer with your advisor. So let's talk about a custom portfolio mindset for a second here. I tell my clients all the time, you do not own the stock market. You own a portfolio that's designed for you. Think about your home. You customized it. You customize the layout, the finishes, the functionality of it. Why wouldn't your portfolio be the same as your home? In the sense that it's for you. It's for your likes. Not everybody's going to like the same tile. Not everybody's going to like the same size living room. Maybe they want an area for special activity. They want a woodworking shop. Maybe they hate woodworking and they're never going to do that. And they want more of a music room. It just depends. Everybody's so different. So your portfolio needs to be designed for you. So ask yourself, is your portfolio built for your income needs? Is it built for your retirement timeline, for your risk tolerance, for your goals? Not for your neighbors, not for your parents, for you. And it's all about you when it comes to this kind of a design. So a customized portfolio, again, is just like your home. It's going to be very personalized to you. Here's some real questions to think about. Are you truly diversified? Do you have too much exposure in one area? Are you being rebalanced periodically? Is your advisor having these conversations with you? When was the last time you talked about the balance of your portfolio, but the diversification, the different kinds of things that you own? If you're not having these conversations with your advisor, then I would encourage you to seek somebody that is willing to have those conversations. is willing to sit down and talk to you like the individual that you are. And that's exactly what we do at Cornerstone Wealth Services in South Bend. So I'd encourage you to reach out, and we'll be happy to schedule some time to talk through this with you. I want to do a specific episode on this, the 7 worst investing mistakes that people make. And these are real mistakes I've seen in almost 20 years, and avoiding just a few of them can change your financial future. So you want to tune in for that. So if you're listening and wondering whether your portfolio is built the right way and it's built for you, then let's talk. Call today, and then we can discuss what your goals are, what your needs are, and make sure that your portfolio is working specifically for you so you can go live your life. In our final episode in this 4-part series, we're going to talk about the 4th pillar, which is a long-term perspective, because without it, none of this works at all. So until next time, money is just a tool. Use it or it's going to use you, but use it wisely so that you can build a life that allows you to live well.